Students, when you see a financial statement of a company, have you ever wondered how much additional informations or disclosures are given in that financial statements other than the balance sheet, profit or loss account or the notes on accounts, right? So, from where do they get these disclosure requirements? Is it from the Ind AS or is it from the Schedule 3? From where? Now, if you see the disclosure requirements, both Ind AS as well as Schedule 3 prescribes various kinds of disclosure requirements which needs to be followed by the companies when they present their financial statements. So there are many disclosure requirements in the Ind AS or Indian accounting standards. Same way, there are disclosure requirements in Schedule 3. Sometimes there could be some contradiction also. Schedule 3 will say you disclose this, but accounting standards might say you don't disclose or you disclose something else, which is contradictory. So which one will prevail? That is what we are going to see now. Okay, so if you see the principle, the disclosure requirements given in the accounting standards, Indian accounting standards, shall prevail over the disclosure requirements which are given in Schedule 3. Okay, so whatever be the disclosure requirements that are given in accounting standards or other provisions of the Companies Act, those disclosure requirements shall prevail over the requirements given in Schedule 3. So the first thing, if there is a contradiction between the disclosure requirement in an Ind AS and the disclosure requirement in Schedule 3, which one should you follow? The disclosure requirements in Ind AS. If there is a contradiction between a disclosure requirements given in the Companies Act, let's say disclosure about managerial remuneration, that is to be disclosed. There are certain requirements in section 198 of the Companies Act. Now suppose there is a contradiction with that disclosure requirements given in 198 and the format given in Schedule 3. Which one you should follow? You should follow the disclosure requirements in section 198. So the Companies Act provisions including Ind AS will prevail over the disclosure requirements in Schedule 3. But except in one case, there is one exception. What is that exception? If you see Schedule 3, Schedule 3 gives you the option for presenting the assets and liabilities in the order of liquidity. Okay, so when you see the option to present the assets and liabilities in the order of liquidity, that requirement in Ind AS, okay, that will have a less weightage than the requirement given Schedule 3. So except for that, all other requirements of the Companies Act or Indian accounting standards will prevail over Schedule 3 requirements. Okay, now what is the second point which I want to discuss? Okay, now disclosure requirements specified in Schedule 3 are additional and the same does not substitute the disclosure requirements specified in the Indian accounting standards. Can you say, see, there are lot of disclosure requirements in the Ind AS. I have followed those disclosure requirements. Because I have followed the disclosures in Ind AS, I don't want to follow the disclosure requirements in Schedule 3. Can I say that? No, you can't. You have to follow the disclosure requirements in both Schedule 3 as well as Ind AS. Only if there is a conflict, you can follow what Ind AS and you can leave the Schedule 3. If there are no disclosures, both disclosure requirements have to be, if there are no conflict, both the requirements have to be followed or disclosed. Okay, that is the second point. Now, additional disclosure as specified in the accounting standards shall be made in the notes by way of additional statement, except where it is to be disclosed on the face of the financial statements. Okay, so if you see the Indian accounting standards, the Indian accounting standard talks about certain disclosures which needs to be made on the face of the balance sheet or statement of profit or loss account. So if the standard says that a particular disclosure is to be made on the face of the balance sheet, you give it on the face of the balance sheet. Or if they say that you have to follow it on the face of the profit or loss, you have to give it on the face of the profit or loss. Other than that, all other information you can give it as a separate note to the financial statements. If you see, for an example, if you see the EPS presentation, okay, EPS, the standard says that the EPS have to be presented on the face of statement of profit or loss. Okay, so you have to show it there, but the calculation of EPS can be shown as a note or by way of additional statement to the financial statements. So if there is a requirement to show it specifically on the face of balance sheet or profit or loss account, you have to show it specifically on the face of profit or loss account or balance sheet. If there is no such requirement, then you can show it even in the notes on accounts. I hope that is also clear to you. Now the last point I wanted to discuss is notes to accounts shall contain information in addition to that presented in the financial statements. Okay, so whatever information you are providing in your face of the balance sheet or face of the profit or loss account, okay, those information also may have to be repeated in the notes on accounts. So that is additional, okay, additional information which needs to be given in the notes on accounts. So friends, these are the 4 points which I wanted to discuss regarding the disclosures. Okay, now we will move to the requirement of mandatory round off. Okay, thank you friends.